This webinar looks at the area of standard costing, which is relevant to the Formation 2 Management Accounting paper and also to the Professional 1 Managerial Finance paper. What is standard costing? Essentially, it's a tool which is used for management purposes. It enables management to carry out the very important task of determining and understanding the unit costs of whatever particular units they may be making. This is derived in the preparation of a standard cost card, which sets out the standard inputs required to produce a particular unit. And that information is very important from a pricing perspective and from a control perspective. As one will appreciate, having arrived at the standard costs of a unit, that enables you thereafter to budget forward by multiplying the sales volume by the sales price per unit as budgeted. You can determine your future revenues for any given period. You can likewise do so for your costs, and then by extension you can budget forward your profit or contribution for a particular period going forward. Standard costing can be used beyond the realms of financial management. It can move into areas such as planning your resource inputs. A simple example would be, of course, if you know precisely how much material is required for each unit in terms of volume and cost, and indeed if you know what units you plan to produce in a given period, well, by definition you can then extend the standard cost card to determine what your purchasing or procurement requirements will be for that particular period. Back to the financial applications, one of the main applications of standard costing is as a control tool, whereby what we do on a regular basis, typically on a short control cycle basis, we review our actual performance against budgeted, or BVA, budget versus actual as the case would be. And in doing so, we compare what was expected with what actually transpired or did happen to derive and understand any differences. So we can understand why there are differences, we can arrive and calculate the performance variances, and indeed investigate such variances, particularly those which are of an adverse nature, and then ideally we can take steps to correct adverse variances at the earliest possible moment. It is important, of course, that all variances are reported in a timely fashion to ensure that the corrective action taken is as early as possible. As the old saying goes, there's no point in closing the stable door long after the horse has bolted. The classical steps you will see in any standard costing system. The first job is through analysis and consideration to determine the standard cost card for a particular unit. Part of the budgeting plan will be to agree what the unit sales price is and what the expected sales volume forecasts will be for a particular period. So once you've determined the standard costs and the budgeted revenues, we then record what actually happened for the period. We record our volumes produced and sold, our revenues derived, and our costs incurred, and they would be recorded in our ledgers. Thereafter, what we will do is we will prepare an operating statement, which is a statement which formally reconciles the budgeted expectation to the actual delivery, and in doing so we will calculate and report performance variances, which will in turn need to be investigated to find out the reasons therefore, and having that information to hand, we can then agree and implement the appropriate corrective actions. Now, as with all walks of life, the management accountant's time is somewhat limited, and which variances are investigated in the context of what corrective actions may be taken will depend, because we will not always necessarily investigate all variances. We shall come to that issue at the last slide in this particular presentation. So what variances are examinable, and what variances will students be expected to be able to compute? I'll run through the 10 variances which are examinable now briefly, and give a brief explanation as to what each variance does indeed report. Do bear in mind, of course, that the reported variance in a given period could be either favourable, whereby you exceed the expectation in terms of sales price or volume, or where your costs are lower than the anticipated standard cost, or likewise they can be adverse, whereby you don't achieve what was expected or your costs exceed those standard costs per the standard cost card. So the variances in particular are, first of all, the sales price variance. Essentially that sets out the extra or lower profits as a result of selling whatever unit you sold at a higher or lower price than budgeted. The sales volume variance is a calculation of the impact on profits of selling more or fewer units than anticipated in the original sales budget. We now move on to the cost variances. There's the direct materials price variance, which reports either the higher or lower cost as a result of spending more or less on materials than the standard cost of each unit of material. The direct materials usage variance looks at or compares the actual usage of the material for the actual quantity of units produced with the standard usage which would have been expected to produce that quantity based on the standard cost card. The direct labour rate is rather similar to the direct materials price variance insofar as it compares the actual rate paid per hour to the standard rate paid per hour to determine whether it was higher or lower, as the case would be it adverse or favourable. The direct labour efficiency variance considers whether or not the use of labour was efficient or inefficient insofar as did we work more hours or fewer hours to produce the actual level of output than would have been anticipated based on the standard cost expectations. The variable overhead expenditure variance is another variance which looks at how much we spend typically per direct labour hour or productive unit against what the standard expectation was. Did we overspend or underspend on that basis? The variable overhead efficiency variance is linked typically to direct labour efficiency insofar as if we work more or fewer hours than anticipated based on standard expectation, that will also have a knock-on effect on the incidence of variable overheads which are incurred. Fixed overhead expenditure variance compares the budgeted fixed overhead for a period against the actual fixed overhead which was incurred for a period. And then we have finally the fixed overhead volume variance. Do be aware please that this only applies when we're using standard absorption costing. In standard marginal costing, there is no fixed overhead volume variance, simply a fixed overhead expenditure variance. In standard absorption costing, the fixed overhead volume variance simply looks at the extent to which fixed overheads were under or over absorbed as a result of producing fewer or more units than what was originally anticipated in the production budget. Do bear in mind that the 10 variances just mentioned are what you might call level 1 or basic variances. There are more advanced variances such as mix and yield and planning and operational, and those variances are not examinable, and that's important for students to appreciate. So those are the 10 variances which are examinable at this level. It's important that students understand what those variances indicate, what they mean, and also that they're in a position to explain why variances, be they adverse or favourable, each of those is likely to have had occurred, because that's typically required in examinations also. A couple of technical points that students need to be aware of. First of all, there are many ways of calculating variances. Some students use formulae, some use grids, some use graphs. It's important to appreciate that all are acceptable. Most examiners will have seen most methods at this point in time, and really it's all about getting the right variances in terms of the calculation. So you use whatever method is comfortable for you, and the examiner can flex accordingly. It's important when you prepare the operating statement that technically the actual and budgeted product or profit or contribution should reconcile. That is the whole essence of the operating statement. In exams that may not always happen. It's a little bit like a balance sheet which may or may not balance. If you have time, do go back and check. If not, you're probably best leaving it and then going back in retrospect if you have time at the end of the question to devote to that. As mentioned a moment ago, students must know the main reasons for each variance and use information in the question to make sensible recommendations for action. In such questions, there's typically soft information which is provided. This is non-numerical information, and that typically does tend to suggest why certain variances may or may not be occurring. And it's important that students can link that information to the variances which they have calculated in the question to link their recommendations to what is actually happening. It's also important that students consider the potential for interdependency between variances. And a good way of looking at this, as a good sign, is to look at two related variances, such as the sales volume and the sales price variance. And if one is favourable and one is adverse, often there may be a consistent or a linked reason for that. For example's sake, an adverse sales volume variance may be linked to a favourable sales price variance. In other words, what has happened is we have increased the price, hence the favourable sales price variance reported, and that has resulted in lower than expected volumes being sold, hence explaining the incidence or the calculation of the adverse sales volume variance. So it's important that students look for interdependencies within the reported variances. A couple of other points. It's important at the outset of a question to appreciate whether we are dealing with standard marginal or standard absorption costing which is being employed. The reason is because, as mentioned earlier on, with standard marginal costing we do not have to report a fixed overhead volume variance. And also the calculation of the sales volume variance will be slightly different, whereby we multiply the volume differential by either the standard contribution per unit in standard marginal costing or the volume differential by the standard profit per unit in absorption costing. So it's very important that students determine which method is being used at the outset. How would one typically do so? In the narrative it may be mentioned that standard absorption or marginal costing is used. If that's not the case, if you look at standard cost cards and there is no reference to fixed overheads in the standard cost card, or perhaps the word contribution is used, that's a clear sign that standard marginal costing is being employed. Likewise, in the standard cost card, if it does absorb fixed overheads into the standard cost of a product and the word profit is used, it's a very strong sign, a clear indication that standard absorption costing has been employed in that particular question. So that's important for students to appreciate at the outset of any question. And once again, as mentioned, the actual and budgeted product contribution should reconcile on that basis. Another point is for students that they should be able to calculate reflex variances. This is essentially where you are given perhaps the variances themselves and you have to use that information to work back to what may be the original standard cost card, or perhaps to the original or the actual costs and revenues incurred. It's a much more complex question. It comes up occasionally in examination questions, and very much students need to have practiced this area, otherwise it can be rather difficult. And if a student is confident in their use of grids and formulae, it should very much go a long way towards them being able to calculate such reflex variances. So when should one investigate a variance, or what will you consider in that investigation decision? Clearly, the extent and materiality of the variance will be critical. The more significant the figure is, clearly the more likely one is to investigate. Regularity of occurrence. If a variance is recurring time and time again, clearly it would be a constant feature of performance, in which case it would merit investigation. Whether it's adverse or favourable, I suppose generally speaking, management will be much more interested in the reason for adverse variance so they can correct such trends rather than favourable. Having said that, there is a strong opinion, a strong view that all variances, adverse or favourable, of a significant nature should be investigated. Because what will happen is, where we have favourable variances, we may be able to take corrective actions or correct actions which can accentuate or improve on the favourable. whether it's due to controllable or uncontrollable factors. Some variances may be less controllable from an internal perspective than others that might have to be considered. And also the cost of the investigation. We need to look at the cost-benefit relationship. If a variance is significant and the cost of investigating it is rather minimal, well, clearly there's a strong cost-benefit rationale for so investigating, and vice versa. I often say if you have a 5,000 variance difficulty with a subsidiary in Australia, why would one spend 10,000 going to Australia to determine the reasons for that? Clearly there will be no cost-benefit relationship in doing so. So that's essentially a quick run through standard costing from an overall perspective, what would be expected of students. At this point, students need to essentially practice questions and understand the various formulae which will enable them to prepare this reconciled operating statement, to consider the reasons for the results they found, and indeed to propose recommendations for corrective action or to accentuate the favourable variance. In terms of relevant questions to look at, there is a question 2 on the April 2010 managerial finance paper at Professional 1 level. It's a question called J Limited. That would be an important question to look at. And likewise on the April 2011 paper, the question 2 there also was a standard costing question, and that is a question called Cologne Limited.